Financial experts and supporters praise the Clarity Act for clear digital asset regulations. Imagine a critical industry thriving everywhere except America, crippled by regulatory chaos. This was the harsh reality of U.S. cryptocurrency markets until yesterday's groundbreaking vote. In a decisive bipartisan move, 294 to 134, the House of Representatives passed Chairman French Hill's Clarity Act, potentially ending years of dangerous uncertainty that drove innovators overseas and left consumers unprotected. Support poured in from across the financial landscape both before and after this historic vote, and their messages reveal why this isn't just policy change, but an economic rescue mission. Here's what key voices in finance and technology declared about this landmark legislation. The American Consumer and Investor Institute framed it as a watershed moment. Years of murky digital asset rules didn't just confuse people. They actively suffocated American innovation, pushed entrepreneurs abroad, and blocked consumer access. The Clarity Act rewrites this story by creating sensible, balanced frameworks that finally serve everyone: consumers, investors, and market players alike. Its bipartisan backing proves lawmakers carefully weighed technological progress against robust citizen safeguards. Anchorage Digital zeroed in on the core breakthrough. Clarity builds the foundation our market desperately needs by answering the billion-dollar question: which digital assets are securities, which are commodities, and why? This clarity isn't just paperwork. It's the key that unlocks America's next crypto policy chapter. For Anthony Hernandez of the Defense Credit Union Council, this is personal. By pushing the Genius Act alongside this digital asset framework, Congress isn't just regulating, they're fortifying. Our military and veteran communities deserve financial systems that innovate fearlessly while protecting their futures, and this delivers exactly that confidence. The Institute of Internal Auditors Anthony J. Pugliese spotlighted critical guardrails. This bipartisan bill anchors U.S. digital markets with consistency and balance. Crucially, Sections 404 and 406 embed non-negotiable investor protections, like requiring exchanges to isolate customer funds from operational cash. These aren't bureaucratic hurdles. They're shields rebuilding public trust in crypto. Cedar Innovation Foundation sounded a competitive alarm. Other nations are sprinting ahead in tech leadership while we stumble in ambiguity. Clarity clears that logjam, and its overwhelming bipartisan support shouts that Congress finally grasps the urgency. Now the Senate must act immediately to secure America's innovation economy for generations. The Crypto Council for Innovation framed the moment as historic. This week's votes on Genius and Clarity end an era of dangerous limbo. Genius finally regulates stablecoins, banning deceptive practices and restricting issuance to vetted entities. But here's where Clarity changes everything. It forces regulators to classify assets by their actual function, not just their sales pitch. This adaptive approach matches overseas frameworks while mandating fund segregation and disclosure rules. Together, these bills are the smart, overdue solution America can't wait any longer to implement. A16Z Crypto's Chris Dixon distilled the impact. 3 words: protect consumers, incentivize builders, keep crypto in America. If we want blockchain to rebuild the internet on U.S. soil, this bill is our foundation. But let's be real, this is only halftime. The Senate must now finish what the House started. Coinbase highlighted the political sea change. Democrats and Republicans now agree. Protecting consumers and unlocking crypto innovation through clear rules isn't partisan. It's common sense. Voting yes on Clarity isn't just policy. It's a national imperative. The Decentralization Research Center spotlighted a subtle revolution. True blockchain progress thrives on decentralization, not control. Clarity's genius? It sets the first ever legal test for when a digital asset evolves from security to commodity status, a threshold vital for healthy, open markets. This isn't just regulation. It's architecture for responsible growth. Kraken issued a stark warning. While the EU and Asia built clear crypto rules, America procrastinated. If Congress doesn't pass market structure laws by August, we'll cement our disadvantage for years. Ji-Hun Kim of Crypto Council for Innovation amplified the risk. Without Clarity's customer fund segregation and bankruptcy safeguards, we're forcing consumers into dangerous, unregulated offshore markets. But here's the controversy. Can any regulation truly balance innovation with protection without stifling one? Lawmakers face an almost impossible tightrope walk. The Milken Institute connected the dots. Clarity, Genius, and CBDC safeguards form a trifecta protecting U.S. financial integrity. Their bipartisan backing proves digital asset policy has matured beyond political football status. Ripple's Stuart Aldarity saw momentum. After years of gridlock, workable crypto frameworks are finally moving forward, proving public pressure for sensible rules can't be ignored. Blockchain Association's Summer Mersinger identified the stakes. Will America lead the digital economy or surrender to China and Europe? The intricate Clarity Act proves complex policy can transcend partisanship when national competitiveness is at stake. The Club for Growth made a capitalist case. Every delay in passing this bill sacrifices American jobs and entrepreneurship to global rivals. Ironically, even though Clarity regulates stablecoins, it actually expands financial freedom by creating alternatives to traditional banks. Gemini's Tyler Winklevoss captured the optimism. The House just changed the game. Now we push towards Senate approval and the president's desk, because regulatory clarity isn't a luxury. It's the oxygen this industry needs to survive. Now here's what keeps experts up at night. Does classifying assets as securities or commodities actually fit crypto's fluid nature? Could these rules inadvertently punish legitimate decentralization? And with global rivals years ahead, has America already lost its lead despite this progress? We want your bold take. Does Clarity strike the right balance between safety and innovation? Or does it risk overregulation? Sound off in the comments. Crypto wins big in America. Understanding the Genius Act and its impact. Imagine a world where crypto reigns supreme in America. That vision took a giant leap towards reality when President Trump, in a landmark moment, signed the Genius Act into law at the White House on July 18, 2025. This groundbreaking legislation marks the first significant crypto regulation passed by Congress, captured in a striking image by Brendan Smialowski for AFP via Getty Images. For years, the U.S. government treated cryptocurrencies like a risky gamble, too perilous for everyday Americans and the financial system. But that era is over. In a historic decision, the House of Representatives voted to approve the nation's first major crypto legislation, signaling a dramatic shift in the U.S. approach to digital currencies. The market responded with exuberance, pushing the total value of cryptocurrencies to a staggering $4 trillion, as reported by the New York Times. During a celebratory ceremony, President Trump, committed to making America the crypto capital of the planet, signed the bill to the cheers of Republican lawmakers. Today, we take a monumental stride in solidifying America's leadership in global finance and crypto technology by enacting the landmark Genius Act, Trump declared. This new law introduces regulations for stablecoins, a promising but niche segment of the crypto market. It also paves the way for more legislation, with 2 additional crypto-related bills currently navigating Congress. But there's a bill that has the crypto world buzzing, the Clarity Act. Passed by the House on Thursday, it's part of what Republicans have dubbed Crypto Week. This bill proposes transferring regulatory authority over the crypto sector to the Commodity Futures Trading Commission, a smaller body. Such a move could revolutionize digital currency regulation in the U.S., but critics warn it could lead to lax oversight of a potentially dangerous financial sector. The Clarity Act now faces an uncertain fate in the Senate, with crypto critics vowing to fight it fiercely. For crypto enthusiasts, however, this was a week to celebrate. They've long believed that digital currencies are the future of finance. While they admit there are less reputable aspects like meme coins, They argue that cryptos offer genuine value. Stablecoins, for instance, are seen as a safer crypto option, backed by traditional currencies like dollars or euros. This means if you buy $1 in stablecoin, the issuer must hold $1 in reserve. Industry leaders envision stablecoins enabling instant, borderless money transfers without hefty bank fees. Kevin Ludeniadi, CEO of Borderless.xyz, a firm facilitating stablecoin payments, predicts, over the next 20 years, stablecoins will become the standard for commerce. But critics see a looming financial crisis. The Genius Act includes safeguards like reserve requirements and anti-money laundering rules. But critics argue these are too weak and heavily influenced by the crypto industry's substantial lobbying and campaign donations, which exceeded $100 million last year. Amanda Fisher, from the consumer advocacy group Better Markets, warns it's all hype. This bill doesn't solve current payment system issues. It exacerbates them, posing risks to consumers and the economy. The stablecoin industry, however, defends the Genius Act's rules, emphasizing their rigor and democratic support. Dante Despard of Circle, a major stablecoin issuer, asserts the law sets clear standards that even large banks must follow. The bill advances a pro-growth, pro-competition, pro-consumer agenda like no other financial regulation in decades. Despite criticism, the crypto sector feels the tide is in its favor, bolstered by substantial financial resources and President Trump's backing. Trump and his family have invested in World Liberty Financial, a company deeply involved in the crypto industry, including developing its own stablecoin. The next big goal for the crypto sector is the Clarity Act, aiming to reduce the Securities and Exchange Commission's regulatory power, which had been stringent under the Biden administration. The SEC, under Gary Gensler, had cracked down on the crypto sector, notably convicting former FTX CEO Sam Bankman-Fried. Crypto companies argue for unique rules for digital currencies, but critics fear this could lead to a regulatory landscape shaped by the industry's financial influence. Mark Hayes of Americans for Financial Reform cautions, "We're conducting an uncontrolled experiment on our financial system with unproven technology." Yet, with the historic passage of the Genius Act, the crypto industry marches forward, emboldened by its recent triumph. What's next for banks after the stablecoin bill becomes law? The recent enactment of the stablecoin bill marks a significant turning point for the banking sector. With President Donald Trump officially signing the bill into law, banks are now preparing to engage with regulators as they develop new rules that could either jeopardize or safeguard the traditional banking landscape. This stablecoin legislation presents both a potential crisis and a chance for banks, according to industry experts. Major financial institutions are indicating their intent to participate in the stablecoin market, attracted by the prospect of offering banking services to this burgeoning and lucrative sector, or even launching their own stablecoins. Mike Nonica, a partner at Covington & Burling, expressed optimism about the new regulatory framework, stating, "People are enthusiastic about the establishment of a solid and lasting regulatory environment for stablecoins." For banks and non-bank entities interested in issuing stablecoins, this framework clarifies what is permissible, and such stability can be invigorating for technological advancements. However, the stablecoin bill did not fully meet the expectations of bankers. The Genius Act, for instance, did not impose a comprehensive ban on stablecoin issuers from obtaining Federal Reserve master accounts, nor did it prevent them from offering yield-like products. This has raised concerns, especially among smaller banks, that the widespread use of stablecoins could completely disrupt the banking system. With the stablecoin bill now in effect, the responsibility for further discussions and regulations falls to the regulators. They face the daunting task of drafting a comprehensive set of rules, particularly regarding how non-bank issuers can participate in the stablecoin market. The legislation has granted considerable flexibility to both the Treasury Department and state regulators to navigate this complex landscape. Karen Petro, co-founder of Federal Financial Analytics, highlighted the focus of her banking clients on the forthcoming regulations concerning non-bank issuers' engagement with stablecoins. She noted, there are significant questions about how a bank holding company or an insurance subsidiary of an insured depository institution can interact with stablecoins. However, the primary concern for most of our clients is understanding the future marketplace and who their competitors will be. The Federal Reserve also plays a crucial role in this scenario. The stablecoin bill maintains the current status regarding master account access for non-bank payment stablecoins, without explicitly prohibiting non-banks from obtaining such access. Petro pointed out, the Fed arguably has the authority to grant master accounts, which is what stablecoin issuers believe. However, banks contest this, and the existing situation leaves the decision in the hands of the Federal. Currently, the Federal Reserve has a policy statement outlining which firms are eligible for master accounts. Nanika mentioned that this policy could either be adjusted to facilitate access for non-bank issuers or to restrict them entirely. The Federal Reserve's policy statement provides guidance on how it assesses requests for master accounts and Fed payment services, and it does not exclude stablecoin issuers from obtaining such access, he explained. Banks interested in entering the stablecoin market face a myriad of legal challenges stemming from the new legislation. Nanika noted, banks will look to their federal regulators for guidance and will need to determine the structure they wish to adopt for issuing stablecoins. Will it be a subsidiary of the insured depository institution, or will it be a separate entity? Where will we position a stablecoin issuer within our corporate framework? The issue of yield presents additional complexities for regulators. It may fall to individual regulators, state authorities, or the Treasury Department to establish rules regarding the types of yield-like products that stablecoins can offer, such as staking or rewards for holding stablecoins. This topic may also be addressed in the upcoming market structure legislation, as noted by Christopher Boone, a partner at Venable LLP. The House has passed a version of this legislation known as the Clarity Act, which is now awaiting consideration in the Senate. Boone remarked, amendments to the Genius Act can be made directly, and the Clarity Act could serve as a vehicle for these changes, although it remains uncertain whether they will tackle the specific challenges, particularly regarding yield. Although the stablecoin bill was passed relatively swiftly in congressional terms, it is anticipated that the market structure bill will take longer to finalize. The Genius Act was passed without significant alterations by the House, avoiding a lengthy and contentious reconciliation process. Senate Banking Committee Chairman Tim Scott, Republican South Carolina, recently released a discussion draft of a bill and initiated a request for information, suggesting that the Senate may be preparing to introduce its own version of the market structure bill rather than adopting the House's version. As the rules are still being formulated, banks and potential non-bank issuers find themselves in a challenging position, attempting to develop products while the regulatory framework is still under construction. Boone summarized the situation aptly. We are essentially navigating a road that is still being built, and the specific guidelines remain unclear.